Welcome to Module 2, Section 2, where I will try to answer the question, what is a stock? Stock represents ownership of a company. If you own stock in a company, you are a part owner of that company. Now, you may not have all the different rights and responsibilities that other people within the company have, but you are a part owner. If you own all of the stock, you are the only owner. Stock is created when a company decides to give away by selling part ownership of a company. And that makes sense. Let's imagine just for a second that you and I get together and we decide we want to go into business. One of the things that we will do is set up a corporation. And you take what money you have and put it into the corporation. I take what money I have and put it into the corporation. And we start to grow and we're starting to see some success. But we're getting to the point where we want to expand. We want to hire more people. We want to build a new factory. We want to do more research and development. Well, even though we're doing pretty good the way we are, we don't have enough resources to be able to do those things. One alternative that we might have is to say, okay, let's take a percentage of our company, maybe 49% or 50%. Generally, owners who started the company will want to have at least 50 or 51% of the company so that they are the majority owner. But we decide, let's give away 30% of our company. And what we're going to do is make stock available to other people. We give them stock and they give us money. And then over a period of time, as our company grows, as our profits increase, the value of the stock that they bought will increase in value so they can keep it on their books as part of their net worth. Or maybe in the future, they decide they want to sell that stock for a greater price than what they gave us in the beginning. The money that they did give us in the beginning, we use that to expand the business in all the different ways that I talked about. Stock is also called equity. So if you're watching the financial channel sometimes and saying, I want to find out what happened in the stock market, and somebody comes on and says, the equity markets were up today, they're talking about the same thing. So don't let that confuse you. Equity and stock mean the same thing in this context. A unit of ownership is called a share. What will happen is a company will say, okay, we have 10,000 shares that we're going to create, and then we're going to attach a value, an initial value, to each one of those shares. As the company grows, the value of each share will go up. If the company runs into trouble and starts losing money, the value of each share will go down. In the stock market, prices fluctuate each day. A company like Apple or Microsoft may be worth $1 billion more tomorrow than they were today because the value of their stock went up. And the inverse of that can also happen. This is done to raise capital and to serve as an incentive for a company to increase profits. If it's just you and I doing the company, yes, I answer to you and you answer to me. That's true. We may even have a board of directors, maybe our spouses or people that we respect that we meet with and we answer to them. But really, that's a pretty small group of people. When you start selling off parts of a company, now you have to answer to the owners. They put up an amount of money to invest in our company, and we better be able to tell them that their money is being put to good use and we are showing growth and an increase in profits. So there's a level of accountability that is attached when you sell off part of your company to raise capital. Most companies in the US are privately held, even some really big companies. They don't have public shares that you can go buy and sell. They might have lots and lots of shares, but they give them to their employees or to investors who they've worked with for a long period of time. You can't just walk into the New York Stock Exchange and ask for a particular company's stock. It has to be publicly traded, not privately held. Thousands of companies also have stock that is publicly traded, and they're usually traded on an exchange. The most famous one is the New York Stock Exchange, and I'll be covering a lot of that in more detail throughout this course. There's also another exchange called the NASDAQ. There's the American Stock Exchange. There are lots of different exchanges located throughout the US and throughout the world. It's hoped that over time, the value of the shares, whether public or private, will increase in value. When a company changes from being privately held to going to a point where the public can buy or sell shares of that company, that process is called going public. Many companies do decide to go public. This is called a publicly traded company. This is a stock that trades where shares can be bought or sold on a stock exchange that is open to the public. Now, don't misread this. You can't just go to New York, walk in the New York Stock Exchange like you're walking into the mall and go over to the Microsoft counter and say, give me 100 shares of Microsoft. Or go over to the IBM counter and say, I want to sell my shares of IBM. No, it doesn't work that way. You do this from home using a computer or through a broker who then transmits that order to the appropriate exchange. And then that process is either handled to buy or to sell. But what it means is anybody, if they have the money, can buy these stocks and at some point sell these stocks if they own them. Investors and traders, again, this has to do with time. Investors, you hold something over a year. Traders under a year. And I'm going to stop saying that in the videos now since I've now mentioned that 2 times. If you have a legal brokerage account, and believe it or not, there are illegal brokerage accounts, you can publicly buy or sell shares of a company if it is publicly available. As the company expands or contracts, the stock's price per share is determined by the market. Stock prices are determined by 2 very powerful forces. And if you've taken any economics class, this will make sense to you. We have the forces of supply. What is available to us? If you have a company that has 10,000 shares available, their supply is 10,000 shares. And then demand. How bad do people want this? Just to give you a simple example, I don't really keep up on the new trendy toys, but I do remember a number of years ago, there were the Cabbage Patch dolls. They were the craze that year, and people could not get enough of them. Well, there was a huge demand for Cabbage Patch dolls, but they started to run out of them. So the supply was limited. Well, what could happen is people really wanted those dolls, so they were willing to pay more for the Cabbage Patch dolls. Now, project this ahead 2 years later. I was in a Toys R Us store back when they existed. There was a whole aisle filled with Cabbage Patch dolls. You had 100 different dolls to choose from. They weren't the craze anymore. They had a huge supply, but not much demand. The general public had moved on to the new latest and greatest toy for Christmas. Well, what happened also? Instead of paying extra for a Cabbage Patch doll, they would lower the price. And when they still didn't sell, they would lower the price even more. Eventually to the point where it was attractive enough for people to come in and buy these Cabbage Patch dolls. And that's really how stocks work. If there's a lot of stock and not many people want to buy it, prices will go down. If there's a real demand for a stock and not a lot of shares out there, that will push prices higher. Prices can be influenced by many, many things, and this can include the real value or lack of value. Every company has a real value. What are their assets? What are their liabilities? What products do they have? What kind of management do they have? What have they done in the past? And what are they looking to do in the future? All of these things can be broken down into what is considered real value. There are other companies that were really valuable at one time that don't even exist anymore. Companies like Enron or Kodak or Blockbuster. At one time, they were real high flyers, but they didn't change and their value started to decrease. Their stock ended up decreasing in value as well to the point where they don't even exist anymore. There's also a perceived value or lack of value, and that's really what drives the stock market. It's not necessarily the real value, that does play into it, but the stock market looks forward. And so prices may be a lot higher than their actual real value. And a report may come out, whether it's a news report or some kind of a financial report, and the market really likes that, and so stock prices will go up. Well, the inverse is also true. If something negative comes out about that company hasn't really changed. It still has the same products, the same management. It's located in the same place. But if they come out and the market doesn't really like what is said, that will push the price lower. That's just the perceived value or lack of value. And a large part of the game that we play in the stock market is determining our perceived values below or above their real value. If they're below, we might be more inclined to buy. If they're above, we might be more inclined to sell. Companies have different types of stock as well. But for individual investors and probably most of you that are taking this course, the type of stock that we deal with the most is common stock. This is what you see being traded back and forth on the different exchanges. When you look up stock prices online or you read about them on a website or a newspaper, you're usually looking at the common stock values. There's another kind of stock called preferred stock, where the price may not fluctuate as much, so you don't get necessarily a lot of capital gains from it, but they're higher dividend paying stocks. Part of the profits that a company will make go through to the people that own preferred stock, and some people use that as a form of income. When a company first goes public, this is called an initial public offering, or IPO. There's usually a big deal made out of this. We know ahead of time when this is going to happen. They might gather some people from a particular company and let them ring the opening bell, or they might come and ring the closing bell on the first day that they trade. So what are the different types of stocks? A company can have many different kinds of stock. It can have as many different kinds of stock as it wants. We're just looking at the kind that we can publicly buy and sell. The two main types of stock usually includes common stock, which I just talked about, and that's usually what you will be involved in the most. This allows you to have voting rights. If you own a share or shares of a company, you have the ability to attend either in person or by proxy or virtually their annual shareholders meeting. And you can ask questions, you can make complaints, you can get to know other investors. Some people really enjoy doing this. Other people don't really have the time. Some common stock does have dividends. Now, the idea behind common stock is usually focused on growth. You want to be able to buy a stock at 10 and at some point in the future sell it for 20. That's a capital gain. Other stocks, not only do you want to see a good appreciation in the value of the stock itself, you like the idea of being able to get dividends or profits from that company as they're being earned. And a lot of investors use dividends as a real deciding factor on something they invest in. The other type of stock that I mentioned before is called preferred stock. This generally does not have voting rights, but they usually pay a higher dividend than what the common stock will pay. And so for some people, especially when you get into retirement, buying into a stock that pays a good 8-10% dividend might be very attractive to you. And you count this from the purchase price, because as that stock increases in value, the dividend rate will go lower and lower unless the company comes out with an increase in profits as well. There are also a thing called classes of stocks, and a company can come up with whatever classes it wants. These different classes may have different voting rights. Some of the stock that you own may allow you to vote. Other types of stock may not allow you to vote. A lot of times they'll have a Class A stock or a Class B stock. There's even some companies that have a Class C stock. And you'll need to understand what it means because it can vary from company to company. Classes can be used to help maintain control. That's why there are 2 Google stocks out there. They created a second type of stock that a lot of people still invest in, but they set it up in such a way so that nobody else could come in and sneak around and become a majority shareholder. Different classes can make a company more difficult to be taken over. That's where one company comes in and buys stock of another company, and the other company doesn't want to be taken over. That's called a hostile takeover, where at some point, if they're the majority shareholder, whether the company likes it or not, they're now owned by somebody else. There's also a thing called advisor shares. These are usually given to business advisors for the risk that was taken, insight, and expertise. For example, a number of years ago, I did some consulting work involving computers with a company. They were just starting out, they didn't have a lot of money, and they couldn't pay me. So what they did is they issued me some stock. That's how I was compensated. I wasn't given actual money at that time, but I was given ownership rights to that company. And as that company grew, those shares became worth more and more over a period of time. And then at one point, I was able to sell those shares back to the company. If you're starting out in a business, you need an attorney, you need a CPA, you need people to help you, you need support staff. Well, you may not be able to give them an awful lot of money, so you might give them stock instead. That's what they did with a lot of the employees at Microsoft. They really didn't pay them all that much. They gave them very lucrative stock options. And then when the stock went public and started to increase in value, and it seemed like it doubled every 6 months there for a while, the people weren't making a lot in their job, but they were becoming very wealthy on the stocks that they had in Microsoft. So that is a common form of compensation. There may be special shares that are given to the people who founded the company or to high-level executives, maybe the CEO, COO, CFO, people that were with you from the beginning. Just to give you a little bit of a sideline story, I'm also a Microsoft certified trainer, and I used to teach Microsoft certification courses. Well, one day, a lady came in to look over the classrooms where I was teaching because she had some program that she wanted to implement. And she looked pretty normal. She wasn't very old. She had jeans on and a shirt. I saw her car. It looked like a nice car. Well, after she left, I was told that was Microsoft's first employee. That woman was worth billions of dollars. But that just gave her the opportunity to do some programs that would help other people because she became very wealthy by taking the risk of going to work at Microsoft before it was a really established company. It can also be compensation for people who help to get the company started or to get it going. And I talked about that before. Different classes may exist for load and no load mutual funds. A load fund means you pay a fee up front. A no-load mutual fund means you don't pay a fee up front. So you may be involved in mutual funds, which I'll cover in an upcoming section, but you may want to get involved in those kinds of mutual funds where you don't have an upfront fee that you pay. What are some of the different kinds of stock? There are growth stocks. This is where you want to see capital gains. Buy it at 10, sell it at 20. There are dividend stocks. You may buy it at 10, it may stay right around 10, but you're getting 10% a year on the dividend and you're happy with that because that is a form of income for you. There are also defensive stocks. These are stocks that tend to do better when the economy is going down. Often we'll call these consumer staples. These are things that people have to have no matter what the economy is doing. Toothpaste, soap, toilet paper. So when things really start to get rough, a lot of investors will head over towards more defensive stocks. Sometimes they perform well in a downturn, or sometimes they perform less badly in a downturn. And then we'll talk about ownership. The more shares that you own, the greater the percentage the investor owns of those outstanding shares. So if you own a lot of shares, you may be a really high percentage owner of that company. Here's one thing that's kind of funny. The property a company owns does not belong to shareholders. So for example, you invest in Disney and you went and you saw the latest Disney movie and you didn't like it. So you go down to the Disney corporate offices and you walk in and you say, well, I'm going to take this chair or I'm going to take this computer. I'm an owner of the company, and I didn't really like that last movie. So to be compensated for that, you're going to have to give me some of the property that you have. No. That's stealing. You do have rights as a shareholder, but not those kind of rights. On the inverse side, what if you get involved in a company like Enron or WorldCom and they end up really breaking the rules and people end up going to prison for the things that they did? Isn't it nice that they won't actually come after you? You're a part owner, shouldn't they? No, not in this case. You are protected. So you may not have access to their property or their assets directly, but you're not also held accountable for their liabilities or any unlawfulness that goes on. Liabilities that are assumed by the company are not the responsibility of shareholders, and that's kind of nice. Shareholders have no rights to company property, as I talked about. Ownership does give you the right to vote in shareholder meetings, and you can usually vote for the board of directors or express your opinion if you don't like what's going on, or maybe even meet some of the people in the company. And if a company declares dividends, you can receive those if you have the right kind of stock. Another nice thing about buying publicly traded stock is if you buy that stock and at some point in the future you want to sell that stock, there's nothing that binds you to that stock and prevents you from selling it. There are a lot of people that buy a stock at 10 o'clock and at 10:15 they sell it. So you have the free ability to buy and also sell anytime you would like. So is going public a good thing? There are advantages and disadvantages to going public or being an IPO. Some of the advantages are to raise capital, as I talked about at the beginning of this section, to pay down debt. A lot of companies incur a lot of debt just to get off the ground, and they want to raise capital through an initial public offering. They may use a lot or all of that money just to get out of debt, to do research and development or R&D, and for publicity. Especially if it's a well-known company, there's a big deal made out of this. But even if it's a small company, there will be press releases, there will be the media involved, there will be people that didn't pay attention to the company before. Now that it's going public, they will pay attention to it. What are some of the disadvantages? There's increased disclosure of information when you are publicly traded because companies that do trade publicly are regulated. This can be costly. Lawyers, accountants, support staff that you didn't need before because there's a lot of extra reports and a lot of laws and a lot of hoops that you'll have to jump through that as a privately held company, you may not have had to jump through those hoops. Then there's an added pressure to increase profits. Like I said at the beginning, if you and I sit down and we create a company and it's a corporation, we only answer to each other or a board of directors or anyone that we go to for advice. Now you also have to answer to the shareholders, and if you're not making profits, they're going to hold you accountable for that. Another thing I want to talk about is a thing called LOT, L-O-T. When a stock trades, it typically trades in a lot, not a lot. We're using LOT as a singular word here. Basically, that just means 100 shares. And that's what I teach people to do because you have a lot of additional flexibility if you buy 100, 200, 300, 400 shares than if you bought 34 shares or 62 shares or 194 shares. Some of you may do it that way. Instead of investing in a certain number of shares, you have a dollar amount that you invest in a company, and then that comes out to a kind of a crazy number of shares that you may own. For a lot of the strategies that I teach and implement in the program that I have, you have to have lots, meaning 100, 200, 300, because we're using option contracts and they're based on 100, 200, 300 shares. For example, a company's shares may be worth $50 per share. In real dollars, that means a lot would cost $5,000. 50 times 100 equals 5,000. Anything different from 100, 200, 300 is called an odd lot. And this can also apply to transactions where you have less than 100 shares. You might buy 72 shares. That is an odd lot. Any trade that is not based on 100 shares is also a form of an odd lot. In the example that I give here is 192 shares. The 100 shares, that is one lot, but the 92 shares, since it's not all the way up to 200, that is an odd lot. So if you wanted to implement some additional strategies, you could do it on the first 100 shares, but you can't do it on the 92 shares. Then the program that I teach, as well as other investors and traders, they don't implement strategies based on odd lots. So that's one thing to be aware of right off the bat. Now, you can still find a lot of value in what I teach, but some of the additional strategies that really can help you have really, really good returns, you won't be able to implement all of those to their fullest unless you buy lots of shares. Now, I'll talk for a minute about stock exchanges. And think of this as like the stock mall. Publicly traded stocks trade on a thing called a stock exchange. After the IPO, the initial public offering, a stock will trade in the secondary market. When it first goes public, that's called the primary market. You have investment bankers that are involved and lawyers and accountants. That gets you all ready. But once you actually go public and everything that you see happening on the New York Stock Exchange or the NASDAQ, that is the secondary market. There are many exchanges in the US and around the world. The most famous one is the NYSE, or New York Stock Exchange. Other exchanges include the American Stock Exchange, which is also in New York, There's the NASDAQ, which doesn't have a real physical location. It's a series of computers that talk back and forth. So let's look at the NYSE. It's located on Wall Street. That's where we get the term Wall Street from, in New York. It's also called the Big Board. And they still have one there today, although it's electronic. But it used to be a big, giant chalkboard. And somebody would be writing down all the numbers on this chalkboard as prices went up and down. And people would just stand and look at that. And since it was so big, they call it the Big Board. It's the world's largest stock exchange. And the combined NYSE market capitalization as of January 2021, that's as far back as I could go, was 24.5 trillion. Now it goes up and down every day, and I'm recording this about 3/4 of the way through 2021, so this number is already out of date. But that's just to give you an idea of the value. The entire stock market was valued at over 50 trillion as of the end of 2020. And even though we had the whole COVID lockdown and all the mess that came with, the stock market, although it crashed initially, did bounce back and had a pretty good year. So we have all of the stocks together that value about 50 trillion. Roughly half of that is on the New York Stock Exchange. The daily trading value of stocks going back and forth, and the most recent number I could find was 2013, which was a long time ago, was 169 billion in dollar terms. But don't really pay attention to that number because for some reason they don't make that readily available. Daily trading volume is about 3.6 billion shares per day as of May 2018. Throughout this course, I'll go through some other instances where I talk more about volume. But when we're looking at the S&P 500 itself, usually if it has anything under 1 billion shares traded each day, that's considered a slow day. There's other days when it might be 2, 3, 4, 5, 6 billion shares that go back and forth. The NYSE was founded in 1817, and prior to that, stock transactions were done according to a thing called the Buttonwood Agreement of 1792. Well, that goes way back to the beginning of the Constitution. So this has been around a long time. There are about 2,800 listed companies, and this changes as some companies go out of business, new ones are added, some companies merge with each other, but that's just a rough estimate. And their symbols are usually 1, 2, and 3 letters. Like the symbol T is for AT&T. I bet you'll never guess the symbol for IBM. Yep, it's IBM. So typically, if you're looking at a stock symbol and it's 1, 2, or 3 letters, that's an NYSE stock. Famous companies that are on the NYSE include General Electric, or GE, which used to be the longest founding member of the Dow Jones Industrial Average, but it was recently taken out. Also Boeing, or BA. There's also another exchange called the NASDAQ. It's the National Association of Securities Dealers Automated Quotations. Who came up with that? We just call it the NASDAQ. It's the second largest stock exchange in the world. Their average daily volume is over 5 billion shares. There's about 3,300 stocks on the NASDAQ. Again, this number fluctuates all the time. It opened in 1971 to allow for advances in technology to be used. And at that time, that meant phone lines. Now it means super fast fiber optic technology going back and forth. Most stock symbols have at least 4 letters. And some examples are, you have Microsoft, MSFT, 4 letters in their symbol. They trade on the NASDAQ. Also Apple, AAPL, and Starbucks, SBUX. And then Google, which there's a couple of different Google shares, but one is GOOG, Goog. So which exchange? We have the NASDAQ, we have the New York Stock Exchange. You might be a little concerned saying, which one do I use? Well, it's really not important for us. Most investors and traders don't need to know which exchange a particular stock is traded on. There are some stocks that trade all over the world, but because of technology, we don't have to really worry about that. Technology allows for proper routing and tracking. If you're at home and you go in and you want to buy shares of Microsoft, even though they're a NASDAQ stock, that trade may take place somewhere else. Arbitrage helps keep prices the same even if one stock trades on different exchanges. Think about this. Let's say you have a stock and it's $10 a share and it trades in New York. Well, it also trades in London and you notice that it's trading for $11 per share. An arbitrage move would be, okay, I want to buy it in New York at 10 and then immediately sell it in London at 11. Well, when you buy in New York, that's pushing prices a little bit higher. And when you sell in London, that pushes prices a little lower. And there are people out there that's their job. They're arbitrageurs, and they're looking for discrepancies on the same stock that's trading in different places. And this happens so fast. Don't think that this is really an opportunity, because there are supercomputers that do this, and they're using so many decimal places to discover the differences. That really works to our advantage. But don't think that this is a good strategy for you to buy it in one place and then immediately sell it in a different place. It's kind of like Bitcoin mining from a smartphone. It just doesn't make sense to do it. You just don't have the power that is needed to take advantage of that. For most investors and traders, all major exchanges are involved. It's in your software. If you use some kind of a desktop app or an app on your phone, you're just looking at what you want to buy or sell, hit the button, and then it's immediately routed to the best place to give you the best price. So that concludes Module 2, Section 2, and I'll pick it up again in Section 3.